Hello and welcome to the Freight Flow Advisor Brief, a show where we look at all freight news, we analyze it, and we put it into a brief in under 15 minutes or less. The last few weeks have really been packed with earnings calls from all different types of freight modes. Rail and particularly intermodal has seen strength. But today we're going to be talking about three earnings reports that tell us everything we need to know about where Parcel is going. We're going to look at UPS, FedEx, and DHL. All three reported within about 5 weeks of each other. And if you only read the headlines, you would think that it was three separate stories. UPS beats and raises, FedEx raises its outlook, and DHL exceeds expectations. Now, this looks like everybody's winning. And there's really nothing new to see here, just your typical earnings print filled with tons of optimism. But as we started to dig a little bit deeper, we noticed that all three of these companies are running the same playbook. And it really tells us about where the broader industry is heading. We're going to start with UPS because their quarter is the cleanest example of what's actually happening. For the second quarter of 2026, UPS did $22.8 billion in revenue. That's up 7.6% year over year. Now, the non-GAAP adjusted operating profit, and that's profit excluding one-time restructuring charges, it came in at $2.1 billion, and that's up 12%. Margin expanded 40 basis points to 9.2%. Now, here's why that number actually matters. For the past year and a half, UPS has been going through this painful, incredibly deliberate process of cutting Amazon volume by more than half. We're talking about roughly $8 billion in revenue that UPS voluntarily walked away from. Now that $8 billion, that's a large number, but what you need to understand is the Amazon volume was cheap, low margin, and squeezing UPS's network. So this was the quarter UPS proved that the bet was right. US domestic segment, which is their core American parcel business, adjusted operating profit jumped 21% year over year. Revenue per package grew 9.3% and growth outpaced their cost per package by 130 basis points. When we look at that and we really translate it, it means they're getting paid more for less volume and it's actually working. CEO Carol Tomé said it herself on the call. All three of their segments contributed to the growth and U.S. domestic delivered, quote, meaningful operating profit growth over 20% versus last year. And UPS didn't just report a good quarter. They raised their full year guidance. Revenue target now sits around $91.2 billion. Adjusted operating profit around $8.65 billion. Adjusted EPS around $7.22. That's really a company telling Wall Street that they've turned the corner and Amazon is in their rearview mirror. Next, we're going to look at FedEx because their fiscal fourth quarter, which ended in May, tells a strangely similar story, but with one big asterisk. FedEx did $25 billion in quarterly revenue. Their adjusted operating margin was around 8.4%. Their adjusted diluted EPS was $6.31. For the full fiscal year 2026, they hit a $94.7 billion in revenue and adjusted EPS of 2024. So that's 7 consecutive quarters of adjusted EPS growth. 7 quarters. And when we look at FedEx over 7 quarters, we have to understand that that's not a fluke. That illustrates a trend. Here's the asterisk though. FedEx just spun off FedEx Freight. This is their LTL business, and now it's a standalone public company. In that same quarter, FedEx reported revenue up 4.8%, but adjusted operating income was down almost 24%. LTL demand is soft. Truckload rates are soft. The freight recession that trucking has been living in for 2 years hasn't fully lifted. So what does that tell us? The parcel and express side of the business, the side that really touches the e-commerce, healthcare, and premium B2B shipment, it's strong. The industrial and trucking side is still struggling. Now, that's the same split we saw at UPS. Premium freight is winning. Commodity freight is still getting squeezed. Now, as we shift to DHL Group, the German logistics giant, honestly, this might be the most bullish number of all three when we really look at it. DHL's preliminary second quarter 2026 numbers, group revenue up more than 10% year over year. Group EBIT, that's operating profit before interest and tax, came in around 1.85 billion euros, up roughly 29% and 1.429 billion a year ago. But look at where the profit came from. DHL Express, their international and air and premium parcel arm, nearly doubled its operating profit from about 730 million euros to almost 1.2 billion euros. A big chunk of that, DHL says, comes from something specific. Their air freight capacity constraints. When there isn't enough cargo space in the sky, whoever controls the space gets to charge more for it. DHL controls a lot of that space. And just like UPS and FedEx, DHL raised its full year guidance. Group EBIT now expected to come in above 6.5 billion euros, up from the earlier guide of above 6.2 billion. All right, we're going to take a quick break, but stick with me because on the other side, we're going to continue talking about what we are seeing in the entire parcel and express industry and how it's pivoting. But first, I want to tell you about something I use literally every day because I created it. If you're a shipper, a broker, a carrier, or honestly anybody making freight decisions, you know the hardest part isn't about finding a rate. It's knowing whether that rate is actually good or not. Is $3 a mile fair for reefer right now? Who knows? Is intermodal actually cheaper than truckload on this lane this week? Well, I guess. You used to need a Bloomberg terminal style subscription costing hundreds of dollars a month just to get a straight answer. And that's exactly the gap that Freight FA is built to close. And specifically, our Freight Flow Advisor chat tool. Freight Flow Advisor is a chat-based AI freight analyst. You literally can ask it any question, such as, what's the reefer rate from Dallas to Chicago right now? Or is truckload smarter than rail? And it gives you real sourced answers pulling from DAT, Department of Energy, the Association of American Railroads, and Class 1 railroad filings. It's not a black box. It's not a guess. It's market intelligence in a conversation. And then it goes one step further. You can take that rate and turn it directly into a carrier-ready RFP. Scope, evaluation criteria, lane templates, all auto-drafted and exportable as a CSV or a document you can send straight to your carriers. Now, here's the part that I think really matters. We wanted to make Freight FA accessible. It's free to start. 10 quotes and 10 Freight Flow Advisor chats a day. No credit card. If you want more, Pro is $24 a month, and it gets you unlimited quotes plus 100 advisor chats a day. It gets you rate alerts and full RFP exports. And if you're running a small team, Desk is about $800 a year for 3 seats with unlimited advisor access and scenario modeling. Compare that to your legacy freight data platforms charging $150 or more per seat per month. One bad rate on one lane can cost you more than a year of this tool. So go check out freightfa.com. So here's my read on all 3 of these earnings together. We are watching the entire parcel and express industry pivot away from volume as the scoreboard and toward yield and mix as the scoreboard. UPS cut Amazon volume on purpose and got rewarded for it. FedEx's premium express side is thriving while its commodity freight arm is now spun off. Now it's struggling a little, but it's going to come around. DHL's profit explosion came almost entirely from one segment, International Express, where capacity is scarce and pricing power is real. None of these 3 companies grew by shipping more stuff. They grew by being pickier about what stuff they shipped. And they charge appropriately for that stuff that's actually hard to move. These are segments that we've discussed before, and more specifically, healthcare logistics, premium e-commerce, and time-critical international air freight. So if you're listening to this, the takeaway isn't the market is strong, all boats rise. The takeaway is the boats are specialized, and some of them got disciplined about pricing and walked away from bad volume. And now those boats are up double digits. The generalist, low margin, chase every load boats have sailed and sunk. So that's the state of Parcel and Express heading into the second half of 2026. 3 companies, 3 continents, one unmistakable pattern. Discipline is paying, and volume for volume's sake is now dead money. If you've enjoyed this show, make sure to share it with a colleague. You can follow us on all social media platforms at The Freight Flow Advisor. We're on LinkedIn, Instagram, and Facebook. You can subscribe to us on YouTube, or you can listen to this podcast on Apple or Spotify. Now, if you want deeper, in-depth analysis, head over to substack.com and search the Freight FA Brief. There, you'll find curated articles with charts, graphs, and analysis to help you make smart freight decisions in the future. While you're there, make sure you subscribe. Until next time, this has been your Freight Flow Advisor Brief.